Most people make these 8 mistakes when they first invest in mutual funds. And these mistakes can have a huge impact on how much money you finally make from your investments. I have been investing in mutual funds for some years now, and I so wish someone had told me this before. So do watch this video to the end so that you can be a better investor than I am. Let's get started. If you are new here, my name is Srijit, and on this channel, we talk all about wealth and happiness, and sometimes mutual funds. Now, I'm not a financial advisor. I'm just a random guy on the internet sharing my experiences. So please do your research before you act on any of the things I say here. A vast majority of people start investing because they have some extra cash lying around. I do understand the reasoning behind it, but trust me, this is not a very scientific way of doing it. For example, when we plan a trip, we don't first book flights and hotels and then decide where to go, right? We first figure out the destination and then plan from there. Similarly, before we start investing, it is very important to figure out why we are doing this. More than just to make money, we need to clearly define our financial goals. This could be buying a new car, funding your child's education, or simply saving for retirement. Write these down first and then choose funds that align with these goals and timelines. For example, equity funds are meant for the long term. So if we need money in another 2 years, we should be looking somewhere else. It totally surprises me how people research for years before buying a $200 phone, but then carelessly invest $1,000 in a fund their uncle or friend recommends without giving it a second thought. It's our hard-earned money, so give it the respect it deserves. Many beginner investors try to time the market. That means buy when the prices are low and sell when they are high. But trust me, it is nearly impossible to get it right, and it often misses the bigger picture. The goal of investing in mutual funds is to build wealth systematically over the long run. They are not a get-rich-quick scheme. So the best way to invest in a mutual fund is through a systematic investment plan or SIP, where you gradually invest over a period of time. Still, if you have a lump sum amount to invest, then park your money into a liquid fund and then invest periodically from there based on the market situation into a fund of your choice. Time in the market matters, not timing the market. Investing in the wrong funds is a mistake, but so is investing in too many funds, and I have seen many mutual fund investors doing that in the name of diversification. It's important to understand that mutual funds are not like stocks. They are by themselves diversified. So investing in too many funds can make things unnecessarily complicated without any real benefits, and you end up with a portfolio of overlapping equities. For example, you don't need both an active large cap fund and an index fund because both invest in the same large companies. Ideally, one index fund might be all that you need, but a good rule of thumb is to limit yourself to no more than 3 equity funds and 3 debt funds. Beyond that, adding more schemes doesn't provide any additional value. It just makes it hard to effectively monitor and manage our investments. When it comes to investing in mutual funds, we can choose the same fund in 2 different forms, regular or direct. In a regular plan, we invest through a distributor or an agent who makes the process easier, but then charges a percentage as a fee for the services. On the other hand, direct plans, as the name suggests, allow you to invest directly with the fund company. And I would say, always go direct. I'm not saying it's bad to invest with an agent, but make sure that the services and benefits you get are worth paying for, because these extra costs can add up over time and ultimately lead to lower returns. But if you are here watching my videos, you are someone who takes your finances seriously. So I'm confident that you are well capable of doing this analysis and selecting the funds yourself. Similar to choosing the regular plan, another common mistake I see beginner investors make is choosing income distribution and capital withdrawal, or the dividend option against the growth one, and that too without understanding the difference. The dividend option is provided by the fund companies for all those who want a regular income from the investment, such as those who are retired. While dividend plans definitely have a place, it's important to know how the dividends are paid, because mutual fund dividends are quite different from dividends we receive from stocks. In mutual funds, the dividend is paid out from the profits derived from the actual sale of units and not from the appreciation of securities held. So the number of units we hold or the value of our investments will be reduced, and the payouts are taxed at our normal income tax slab. So if you are at the highest tax slab, more than a third of the payout could be lost to taxes. So for the majority of investors who are in the market, growth plans are usually a better option to build wealth as they allow for better compounding of the money. Once we find the right fund for us and set up a SIP, forget about it and give it time. There will always be short-term market fluctuations. And if you monitor this every day, this can cause panic. And when we panic, we tend to follow what others are doing, even though it may not be necessary for us. If a fund has a bad year, don't rush to sell it off. Give it time to recover. Remember, we are in this for the long term. And the market rewards patience. Again, mutual funds are not like stocks, so avoid frequent switching. This will only result in more transaction fees and taxes without any actual benefits. But that being said, we still may have to sell funds at some point if one of these three conditions is met. 1. Our financial goal is achieved. 2. The investment strategy is not aligned with our goals anymore. Or 3. The fund's performance has been consistently poor over time. However, we won't know this if we don't periodically review our portfolio. Investing in mutual funds isn't a one-time activity. I review my investments once a year using a Notion template where all the information about my funds is available. Just by having a look, I can tell which funds are performing well and which are not. If you are interested in my system, I will put a link in the description below. But you don't need such an extensive system. Just use an Excel or a notebook. But do monitor them once a few months. Investing is always a more productive use of our money than keeping it under the mattress or in a bank account. And mutual funds are one of the best options out there for retail investors to do that. But it's important to be realistic with our return expectations. Don't get carried away by short-term bull rides in the market. There is no way to predict the future and no way to know how our investments will perform in the long run. If we manage to get around 10 to 15% return from our investments, we should consider ourselves lucky. I hope you got some value from this video. If so, give it a like so that the message can reach more people and help them also to avoid these mistakes. If you want to avoid the distributor cost and find the right funds for you, then you can watch this video where I have explained my step-by-step selection process. Until I see you with another video, have a wonderful rest of the day and adios.